Picture this. A hidden tsunami of risk is building beneath the surface of global markets. Trillions of dollars of derivatives are left unbacked, and institutions are scrambling for every last US dollar. When the curtains finally lift, the system could seize up overnight. Welcome to the global liquidity crisis. Hello and welcome back to StockScope Live. I'm your host, Ali, and today we're exposing the global crisis that is threatening a total breakdown of the financial systems. Banks, hedge funds, shadow banks, they're locked in a fight, in a desperate race for US dollars to meet the collateral calls on these massive derivatives positions. Stay tuned as we reveal the truths behind this dollar shortage and what it means for your investments. Now, first of all, I want to explain to everyone what derivatives are so that we all can benefit from this video. Derivatives are financial contracts. The value is derived from underlying assets. Think of things like stocks, bonds, commodities, interest rates, or currencies. Common types include futures, sometimes forwards, options, and swaps. Traders use derivatives to hedge risks. They speculate on price movements or arbitrage market inefficiencies. For example, a currency swap lets two parties exchange cash in different currencies over time. While derivatives can reduce the risks, they also introduce leverage and counterparty exposure. A single market move could trigger a massive margin call, forcing participants to post more and more collaterals instantly, and that's why derivatives lie at the heart of today's liquidity crunch. We're going to break this down in 4 key points. The derivatives margin squeeze. Since the 2008 crisis, regulators have forced most over-the-counter derivatives into central clearinghouses, and they imposed strict bilateral margin requirements. The variation margin calls now adjust daily market-to-market changes, while initial margins must cover potential future exposure over a stress period. When there is volatility spikes, these margin calls explode. Banks and funds must post cash immediately. In March of 2020, margin calls doubled in days. Firms scrambled to liquidate assets to raise dollars. This triggered a vicious cycle of fire sales and most margin demands. The result was a systematic liquidity squeeze that caught many off guard. Point number 2. The Basel III's HQLA and balance sheet constraints. Basel III requires banks to hold enough high-quality liquid assets to survive a 30-day stress scenario. That's trillions in high-quality liquid assets parked on balance sheets. At the same time, the supplementary leverage ratio penalizes reserves and treasury holdings, making it costly for banks to intermediate dollar fundings. This clash has choked the dollar intermediations. Banks pull back at the end of quarter ends, derivatives spike, and the cost of the synthetic dollar borrowing through the FX swaps goes ballistic. Key point number 3. The shadow banking and repo market freeze. Shadow banks, which are money market funds, investment vehicles, non-bank lenders, they hold a staggering 65 trillion in assets, but they lack the most important thing: direct access to central bank liquidity. They fund themselves in the repo market. When repo rates surge or lenders demand higher collateral, shadow banks face margin calls they just simply can't meet. In flash freeze events like in March 2020, there was a lot of repo haircuts, and funds sold treasuries en masse. This valley to peak selling drove yields higher and prices lower. They starved the system of dollars when they were needed the most. Key point number 4 is the Dollar Milkshake feedback loop. According to the Dollar Milkshake theory, all major currencies are milkshaked into the dollar at the time of stress. Global investors rush to the dollar strengthening it further. Foreign borrowers then struggle to service dollar debts, forcing them to sell local assets and hoard even more dollars. With quantitative tightening draining reserves and higher Fed rates, this loop accelerates. We could see a cascade of currency crises and debt defaults. And I'm going to mention a bonus point 5, the policy backstops and the shortcomings that come with it. The Fed's emergency swap lines and FEMA repo facility injected over $450 billion during COVID-19. But these lines have expired. Access is limited to sovereign and primary dealers, and political pressures may cap future usage. The other thing is that right now we're seeing that the economy is doing not so hot, but the dollar stays strong. And this is because liquidity requires dollars. Debts are denominated in USD. And even though there's tariffs and there's a trade war and all these deficit spending, demand for dollars stays strong. If this deep dive into liquidity crisis opened your eyes, smash the like button, subscribe to the channel, and ring the bell for more videos like this that help you protect portfolios from the next financial storm. Most importantly, make sure you share this with loved ones that may be impacted, because the global liquidity crisis is unfolding as we speak. Massive derivatives exposures, regulatory constraints, and shrinking Fed balance sheets create a perfect storm. Stay vigilant, diversify your holdings, and consider safe havens. Make sure that you watch out for these dollar shortages. Thank you for watching till the end of the video, and I'll see you in the next one.